Hi, everybody. Gary Hughes here, Nova Agent, novaagent.com. Listen, I've had a number of people recently ask me about this housing market. Even got an email from a customer who's overseas and wasn't sure he wanted to buy it just yet. Someone told him he's better off to rent for a year because, get this, housing prices are going to go down. Well, why does someone think that? It's because they look at the rate of increase that happened just before the 2006 collapse. And then you look again at what happened last year, you see a very similar slope. So one assumes that if the slopes are similar, then what's going to happen next is similar. Not so. Not every black and white horse is a zebra. So let's talk about why that is. So in 2006, what caused that big spike and then what caused the burst? Well, one of the things that caused the big spike was lending practices. And there was a lot of risk in the market. People were selling lousy loans and then packaging them up and selling them as securities. So they were, quote, securitizing these loans. And then when things started to fall out, the people with these security packages found out that they weren't worth the paper they were written on. So let's go back to the very beginning of that and see what we mean by these lousy packages. Basically, a loan has two risk components to it. One is product risk, and the other is borrower risk. Now, as we take a look here at the borrower risk, what we see leading up to 2006 is that a lot of people with very low credit scores, with lots of liabilities, who were marginally, if at all, qualified for the loans, got the loans. The product risk were these risky products that were out there promising to pay less than your full amount for the first 5 years, and then your rate will go up to compensate for it. Those were adjustable rate mortgages, not the good kind. And a lot of people ended up getting slammed with that. So they had a very low payment to start out. Everybody thought that was great. Suddenly the payment doubles or triples and you're not able to make the payment. You got to bail out on the house. You don't have any equity in it, right? Matter of fact, probably have negative equity in it. And so you let the bank foreclose on it. So foreclosure rates went up. The bonds were determined to be worthless. The bottom fell out of the economy. And we saw this housing recession. Then we see it start to pump back up and everything's going kind of normally. It starts to escalate a little bit more. And now we're into 2021, where we see this other steep increase. Well, what's causing this steep increase? Well, for one thing, we do not have the same kind of risk in the system that we had before. That is to say that borrowers generally have higher credit scores. The lenders are being more conservative with giving loans. We are not seeing foreclosures at anywhere near the rate that we saw them in 2006. And even though there was a lot of difficulty at the beginning of COVID, when the banks started doing forbearances, what we've seen now is a steady decline of people in forbearance. Another way to say that, more and more people are getting out of forbearance. Where at one point in time we had almost 5 million homes in forbearance, we're now down to under 1 million. So most of those, 80% of those homes who came out of forbearance came out of it with no negative consequences. That is, the home wasn't foreclosed. And even those that did have some foreclosure, most of them had some equity in it. So it wasn't nearly as bad. We don't see the same number of ARMs that we saw. For example, in 2005, 2006, almost 1 out of every 4 loans was an ARM, adjustable rate mortgage. Today, it's down to about 1.7%, or under 2 out of every 10 loans are ARMs. So add to that, right now, foreclosure rates are at an all-time low. We did foreclosures at the rate of almost 3 million a year there through 8, 9, and 10. And in 2021, there were 151,000 foreclosures, and in 2020, there were 214,000 foreclosures. So anybody who's tried to find a good deal on a house and was looking for foreclosures recently, haven't been able to find one, that's why. So let's go back again and compare. 2006, high rate of foreclosure. 2021, all-time low foreclosures. So that's why there are two different things. The things that are driving these increases are two different things. The basics are different. So what could happen now? Well, we have inflation ticking up, and we have some economists talking about the possibility of a recession. Well, home values have increased every time the interest rates increased more than 1% in a year. So we know that that's the case. And if you take out 2006, that recession, well, let's leave that in for a minute. If you leave in 2006, 4 out of the last 6 recessions, we've had home prices increase. Take out 2006 because that was caused by housing, right? And you end up with 4 out of the last 5 recessions, home prices have increased. So what do we see for the future? If interest rates continue, home prices will continue to go up. They won't go up at the same rate, and that's a good thing. So this year probably going to go up 9%. At least that's what the forecasters are saying. I think it's the average is either 7 or 9% for all of the forecasters. Next year, though, it's going to drop down to probably 3 or 4% and stay in that range for a long time, 3 to 4 years. So that actually is a good thing. That is sustainable growth. This 9, 10, 12, 18%, that's not sustainable. Everyone knew it was not sustainable. That curve has to bend. And so bending it is a good thing. That's not a bad thing. So where does that leave us? Let's take a look at months of inventory, and this is part of the problem. We do not have enough houses on the market. Generally speaking, the way inventory is measured is by months of supply. That is, if no house went on the market after today, how long would it take for every house on the market to sell if they sold at the same rate that they've been selling for the past week or that they're selling right now, okay? Typically, less than 6 months is considered a normal market. Less than 3 months is a buyer's market. Right now in this Maryland, DC, Virginia area, we are under a month. So we are extremely low on inventory. We have a lot of buyers in the market. Why do we have a lot of buyers in the market? We have millennials coming of age to buy a home. They've been working long enough. They now have jobs. They've saved up some money. They're qualifying for loans. Not necessarily the 20% down loan, but they're getting the 3.5% FHA loan. Some are coming out of the military. They're getting VA loans. They're getting 5% conventional loans. They're getting 10% conventional loans. So they are getting loans, and they're now in the market, okay? Remember, the baby boomers didn't all die off, and they all didn't go into a nursing home. So that big group of baby boomers is still there in their home. Maybe they're downsizing too, but they're still in the home. So we have the baby boomers still in the home. We have millennials coming into the market. And in this area, we have a very strong employment base. Now, what does that have to do with it? It means that we have employers bringing employees to this area, and in some cases transferring an operation to this area. Most recently, I think it was Boeing, who just announced they're moving their corporate headquarters to Arlington. Corporate headquarters in Chicago had 500 employees. So we're now at 500 more people who are going to be competing for homes in this area in the next little bit of time. We have Amazon moving in. We have a lot of stuff going on from employment. So we have that piece as well. And then the unspoken, we always hear about low inventory. We don't hear about this. For the last 14 years, builders have been building fewer houses than they have on average over the last 50 years. And that's a response to the 2006-7-8 debacle, that recession. Builders still have not completely ramped up from that. Of course, a number of them went out of business, but they haven't completely ramped up from that. Tack on to that, with the coronavirus, we have supply chain problems. You have difficulty getting wood out of Canada. We have difficulty transporting it. We have difficulty making appliances. Sometimes you've got 6, 8, 12 months backup for certain appliances. Sometimes it's 2, 3, 4 months backup for furniture. Everything is slow right now. So bottom line, we're not building enough houses to keep up with demand. So if demand is increasing and supply stays the same, you end up with a low inventory. That's exactly where we are, and that's what's been driving the increase in price, combined with this artificially low interest rates. So when you got interest rates down around 2-3%, everybody ought to be jumping into the market. People are jumping into the market. 2%, 3%, crazy money. They're almost giving it to you. If you got a 2% loan and 3% inflation, you're kind of honor bound to take that. So anyway, we've got loose money, constricted supply. What's going to happen? Prices are going to go up. Does that mean they're going to collapse? No, they're not going to collapse, but they will level out. The rate of increase is going to decrease. The price is not going to decrease. Okay, well, I hope that is helpful in understanding what's going on, why I still think it's a great time to buy. 5-6% interest rate is not bad. It probably is not going to go, my guess is it's not going to go much above 6. If it does, it'll still come back down to that 5-6% range. And for the first-time buyers, don't forget this, just out today. One of the key drivers of inflation is rental inflation. So rents are going up faster than almost anything else. So you stay in your rental because you're afraid of buying. What's going to happen is your rent is going to go up way more than your mortgage payment would have gone up. So get that mortgage, stabilize those costs, secure your future. Anyway, if you have questions, please reach out to me. My name's Gary. I'm Nova Agent. I'm at 703-939-0668. Or you can reach me at gary@novaagent.com. And my partner Yogi is right here. He's a little bit shy, tired from the weekend, but he's sitting right here with me. And Yogi says, yeah, listen to him. All right. Talk to y'all later. Bye.